Welcome to the debate here on Cognitive Dose, where our core mission is curing blind spots and shattering cognitive bias.
Yeah, it is great to be here for this one. This is it's a deep investigation today.
It really is. So Warren Buffett famously calls it the greatest book on investing ever written. I'm talking about Benjamin Graham's The Intelligent Investor. For over 7 decades, this text has been treated less like a financial guide and more like, immutable physics.
Right, it's the absolute gold standard for value investing.
Exactly. And the premise is incredibly comforting, right? You buy a stock significantly below its intrinsic mathematical value, you maintain your emotional discipline, and, well, you build wealth. It's a beautiful theory.
It is, but there is a massive tension in the financial world today. I mean, if you strictly apply Graham's formulas to modern markets, you wouldn't buy a single technology stock.
You'd miss out entirely.
Completely. You would miss the greatest wealth generation of our era, and honestly, you might actually underperform a basic index fund. So our specific question for today's debate is this. Is Benjamin Graham's framework a timeless blueprint for rational investing? Or is it a dangerously outdated map for a landscape that fundamentally no longer exists?
And I will be taking the position that human psychology and the mathematical laws of risk, they don't change. I believe Graham's guardrails are just as vital today as they were in 1949.
And I brought the research dossier today to argue the opposite. I look at the structural reality of the 21st century economy and see a completely different picture. I mean, I'm arguing that Graham's metrics are not just mathematically obsolete, but that strictly adhering to them today actually blinds investors to systemic risks. And in many cases, it actively incentivizes the destruction of real corporate value.
That is a bold claim. So let's start with the foundation, just to make sure we are all on the same page. To understand why Graham is so revered, you really have to understand the sheer elegance of what he built.
Oh, absolutely. The logic is airtight for its time.
Right. So he introduced a concept called the margin of safety. And he actually borrowed this from engineering. So if you are building a bridge and you know that the heaviest truck that will ever cross it weighs, say, 10,000 pounds.
You don't build a bridge that holds exactly 10,000 pounds.
Exactly. You build one that can hold 30,000 pounds. That 20,000-pound gap is your margin of safety. It protects you against miscalculations or structural fatigue or just unforeseen events. And Graham simply applied that to the stock market. If you calculate a business as worth $100 million based on its hard assets, you don't pay $100 million for it.
You pay $60 million.
Right. You demand a discount, and he used strict quantitative rules to find those companies. He wanted a price to earnings, or EPS ratio below 15. He wanted a price to book ratio below 1.5.
And we should probably mention his most extreme version of this, right? The net-net strategy.
Oh yes, the net-net. This is where you find a stock trading for less than its current assets. Literally just the cash and inventory minus all of its total liabilities.
Which is wild to think about today.
It is, because you are essentially getting the entire operating business for less than free. And I mean, the math there is undeniable. Buying $1 for 50 cents is a universal law of wealth creation, regardless of the decade.
Well, I'd say it is a universal law. Only if you can accurately measure what $1 is. And this is where the dossier shows the framework collapsing today.
Okay, let's get into the investigation then. Where does the measurement fail?
So, the global economy has fundamentally transitioned from tangible goods to intangible assets. We aren't just talking about railroads and steel mills anymore. We are talking about software architectures, proprietary data networks, intellectual property.
Brand equity, things like that?
Exactly. Now, Graham's metrics are entirely dependent on a company's book value. But in the modern knowledge economy, book value is a profoundly distorted metric because of GAAP accounting.
Wait, hold on. Generally accepted accounting principles. GAAP accounting is the standardized system that ensures companies aren't just, making up numbers to look profitable.
Right.
It's the ultimate conservative guardrail. I would argue that aligns perfectly with Graham's philosophy.
It is conservative, yes, but it's conservative to the point of structural distortion. Let's look at the actual mechanics here. In Graham's era, if a company built a physical factory, that cost was capitalized on the balance sheet.
Meaning it was treated as an asset that depreciated slowly over time.
Right, over 20 or 30 years. That factory supported the firm's book value. But today, If a company like NVIDIA spends billions on research and development to build proprietary software architectures like CUDA or Tensor.
GAAP rules force them to expense that massive outlay immediately.
Exactly. Immediately on the income statement.
But that makes sense, because R&D isn't a guaranteed asset. I mean, a physical factory can be sold to another manufacturer if things go south.
True.
If a tech company spends $5 billion trying to develop a new microchip and it fails, that code is totally worthless. Expensing it immediately reflects the real risk of innovation.
I hear you. But it mathematically punishes success. When highly innovative companies heavily reinvest in themselves, GAAP forces them to categorize that strategic technological investment as an operational loss.
Ah, I see what you mean.
Yes, it artificially depresses their short-term profits and absolutely decimates their perceived book value. So these massive, world-changing wealth generators become completely invisible to Graham's rigid price-to-earnings and price-to-book spreadsheets.
So a strict value screener would look at early Amazon and say it's a terrible investment.
Totally overpriced. It would completely miss the impenetrable economic moat that their R&D is building.
Okay, I see the accounting friction there. But I would argue that friction is exactly what saves you from catastrophic losses.
How so?
Well, yes, strict adherence to Graham might have kept you out of NVIDIA, but, it also kept you out of Pets.com in 1999, and it kept you out of the cryptocurrency collapse a few years ago. Intangible assets are notoriously vulnerable to hype.
Sure, they are.
So Graham's metrics act as an immune system against speculative bubbles.
Except the academic data in our dossier shows that the immune system has stopped working entirely.
Really? Entirely?
Yeah, we don't have to guess if Graham's specific criteria still work, we can measure it. Robust evaluations using the FAMA French FMH French 5-factor model show that these historical value metrics generate zero statistically significant alpha in modern markets.
Let's make sure we clarify that for the audience. The FAMA French FMH French model is an academic framework, right? It explains stock returns through 5 factors: market risk, the size of the company, and the value factor.
Which they call high minus low, or HML.
Right, meaning high book to market versus low. And it also looks at operating profitability and investment patterns. So you're saying the HML factor is dead?
Correct. When you control for all those variables today, the supposed genius of picking stocks strictly below book value just disappears.
But what about his disciples? People point to them constantly as proof.
The defense of Graham always relies on his famous disciples, right? But their outperformance is largely a statistical illusion. It's fueled by survivorship bias.
A statistical illusion? That is pretty harsh.
Well, think about it like this. It is like gathering 10,000 people to flip coins. A few of them will inevitably flip heads 20 times in a row.
Just by pure mathematical variance.
Exactly. And then we write books about their superior coin-flipping methodology, completely ignoring the thousands of people who used the exact same methodology and went totally broke.
Well, I am not fully convinced by the coin-flipping analogy, honestly. It completely dismisses the rigorous business analysis these investors perform. They aren't just flipping coins.
But the math...
But even if I concede that the traditional HML value factor, buying purely based on a low price-to-book ratio, is struggling to capture modern software companies, isn't that just a reason to update the inputs rather than scrap the philosophy? The principle is still don't overpay.
The problem is, what happens when you do find a company that actually meets Graham's strict criteria today? Because of the shift to the intangible economy, the only companies that still look cheap on a price-to-book basis are often legacy businesses in secular decline.
Okay, declining businesses. Fair.
And this brings us to a much darker reality in the research. If Graham's metrics just caused you to miss out on tech stocks, that would simply be an academic problem. But applying his math to legacy businesses today actively incentivizes the destruction of corporate value.
Destruction of value?
Yeah. I am talking about how the net-net strategy effectively birthed modern vulture capitalism.
Wow, okay, that is a very heavy accusation. Graham was an academic. He was an analyst trying to protect minority shareholders, not a corporate raider. Walk me through the mechanics of how finding a cheap stock destroys the underlying company.
It is inherent in the math of the net-net formula. Remember, you are identifying a stock priced lower than its stripped-down cash and inventory, minus all its obligations.
Right.
When you do that, you are essentially establishing that the living, breathing operations of the business are a liability. You are valuing its human capital, its institutional knowledge, and its community relationships at less than zero.
Because the actual day-to-day business is preventing the investor from accessing that underlying cash pile.
Exactly.
Which, well, from a strictly financial perspective, might actually be true. I mean, if a legacy retail chain is bleeding money every quarter, the market is rationally pricing the fact that management is incinerating the cash on hand.
But look at the behavior that valuation incentivizes. When strict value investors or hedge funds take activist positions in these net companies, their mandate isn't to fix the business.
They want to unlock the value.
Right, and their immediate financial incentive is to aggressively strip assets. They halt long-term R&D, they slash payrolls, they close functional but low-margin plants, and they just liquidate physical assets.
All to forcefully close the gap between the market price and the calculated liquidation value.
Yes. They view workers not as vital assets capable of turning the company around, but as costly operational liabilities hindering a statistical arbitrage.
But surely that is a critique of modern corporate governance, not Benjamin Graham's book. Graham was looking for discrepancies in market pricing.
But his math provided the justification.
Look, if a company is genuinely worth more dead than alive, keeping it on life support at the expense of shareholders is a massive misallocation of capital in a free market.
It became the prevailing ideology, though. Graham's mathematical purity laid the groundwork for what academics call maximizing shareholder value.
Which replaced the older corporate model.
Exactly. Economic historians like William Lazanek have documented this shift. In Graham's day, we had a retain and reinvest model. Profits went into worker wages, continuous training, and robust internal growth.
And you're saying the obsession with intrinsic value and statistical cheapness replaced that?
Yes, with a highly destructive downsize and distribute model.
And I suppose the primary mechanism for that distribution today is the open market share buyback?
Oh, absolutely.
But again, I have to defend the underlying logic here. If a mature company, say, a traditional consumer goods brand, has saturated its market and has no high-return R&D projects available, what should management do with the excess cash? Value. Returning that capital to shareholders via buybacks so the investor can deploy it elsewhere? I mean, that is exactly what a rational capital allocator should do.
It is rational in theory, but it is predatory in practice. Corporate insiders frequently utilize regulatory safe harbors, specifically SEC Rule 10b-18.
Right, which passed in the early 80s.
Exactly. Before 1982, a company buying its own stock in the open market was heavily restricted because it looked like market manipulation. Rule 10b-18 gave them a safe harbor to buy massive amounts of their own shares without facing manipulation charges.
And how is this being weaponized today?
Insiders deliberately loot organizational capital. They take on cheap debt, they defund long-term projects, and they funnel billions into buybacks.
Because shrinking the number of outstanding shares mathematically increases the earnings for the remaining shares.
Exactly. The total net income of the company hasn't changed at all. The underlying operational health hasn't improved one bit. But because you divide those earnings by a smaller number of shares, the earnings per share, or EPS, mechanically skyrockets.
Oh, and executive compensation is tied to that.
Almost always tied to hitting EPS targets. They are using the company's treasury to artificially inflate the exact metric that value investors idolize. It triggers their own massive stock option payouts, while leaving the underlying company totally starved of the resilience it needs to survive a downturn.
Okay, I will grant that executives manipulating EPS targets through debt-fueled buybacks is a massive agency problem. It feels a bit like harvesting the organs of a healthy patient because the parts sell for more on the black market than keeping the patients alive.
That is a perfect analogy.
But I have a hard time accepting that the market is entirely blind to this. If a company hollows out its future to boost short-term EPS, modern efficient markets should theoretically punish that stock's multiple because its long-term growth rate has collapsed.
That assumes the market is a perfectly rational discounting machine that seamlessly enforces the rules. And that brings us to the structural and cultural blind spots embedded in Graham's worldview.
Cultural blind spots.
Yes. Graham implicitly assumes that the rule of law will always eventually force market prices to reflect underlying asset values. But this methodology suffers from acute weird bias.
Ah,
Weird standing for Western, educated, industrialized, rich, and democratic.
right.
Graham's entire calculus requires highly predictable bankruptcy jurisprudence, robust securities enforcement, and absolute transparency in accounting.
Which works perfectly in mid-century America.
But export this framework to emerging markets, take China for example, and it completely disintegrates.
Because the macro-political structure overrides the balance sheet.
It renders the balance sheet essentially meaningless for a minority shareholder. The rapid economic growth in these markets often relies on state-owned enterprises and, well, complex capital structures designed to serve state interests.
Not shareholder interests?
Not shareholder interests. Exactly. So if you, as a Western value investor, calculate a beautiful margin of safety based on a published balance sheet, but you lack the legal mechanism to enforce your property rights in the event of state expropriation, your calculation is just a fantasy.
That makes sense. You cannot rely on a mathematical margin of safety in a jurisdiction where the state can unilaterally alter property rights or fine-tech monopolies into submission overnight.
Right. Or restructure debt outside a transparent judicial process. Assuming financial mathematics transcend geopolitical boundaries is a massive systemic blind spot.
That is a fascinating point from the dossier. A value investor might look at a Chinese tech giant trading at a PE of 8 and think they have found a classic Graham bargain. They completely ignore that the discount is not a market inefficiency, but a very rational pricing of geopolitical and expropriation risk.
Exactly. The map doesn't fit the territory.
I concede the legal assumptions are culturally bound, but let me push back on this next point. Let's shift away from the math and look at the behavioral side, because this is where I believe Graham remains undeniably brilliant. I am talking about his most famous psychological tool, the allegory of Mr. Market.
Ah, the manic depressive business partner.
Right. Graham tells the investor to imagine they own a business with a partner named Mr. Market. Every day, Mr. Market knocks on your door and quotes you a price at which he will buy your half or sell you his.
And his moods swing wildly.
Yes. Sometimes he is euphorically happy and quotes an absurdly high price. Other times he is deeply depressed and offers to sell his half for pennies. Graham's lesson is that the intelligent investor should completely ignore Mr. Market's emotional state, except to exploit it, selling into the euphoria and buying during the panic.
It is a great story.
Regardless of algorithms or intangible assets, human beings are still driven by fear and greed. That psychological framing has to remain valid.
It is beautifully written, but academically, the Mr. Market allegory is a dangerous logical fallacy today. Specifically, it is the fallacy of a false dichotomy.
A false dichotomy? How so?
By anthropomorphizing the global financial system as a single, highly emotional human being, Graham trains investors to fundamentally misinterpret the complex, algorithmic nature of modern market microstructure.
But whether it is a human panicking or a computer panicking, a plummeting price still creates a discrepancy between price and intrinsic value, doesn't it?
Not necessarily. Because the market today is not a single emotional human. It is a highly interconnected web of algorithms, passive ETFs, options market makers, and institutional clearinghouses. When prices plummet violently today, it is rarely just irrational fear.
What is it then?
It is driven by high-frequency algorithmic cascades, forced liquidations, and systemic counterparty deleveraging.
But doesn't that just prove Graham's point? An algorithmic flash crash pushes a stock's price way below its fundamental value. The disciplined investor who refuses to panic can just step in and buy that asset at a steep discount.
Only if the system holds. The Mr. Market metaphor conditions the investor to view all volatility as mere emotional noise. It gives the retail investor a false, comforting sense of psychological superiority.
Oh, I see. They sit there thinking, everyone else is just being emotional, I am the rational one.
Exactly. While totally ignoring the structural reality of the machine they are interacting with. If a market drop is actually a mathematical repricing of systemic risk, like a sudden liquidity vacuum where buyers simply cease to exist, treating it like a moody business partner leaves you completely blind to the fact that the underlying structure itself might be breaking.
That is a stark distinction. Trying to treat a highly networked, algorithmic clearinghouse like a manic depressive human is, well, it's like trying to psychoanalyze a calculator.
That is exactly what it is, and it directly subverts the margin of safety. The whole point of the margin is to have a mathematical cushion against calculation errors. But if your framework cannot comprehend the algorithmic triggers that cause modern flash crashes or the systemic risks of ETF uncoupling, your calculation of risk is fundamentally incomplete.
You don't actually have a safety margin at all.
No, you just have blind faith in a metaphor.
Wow. This brings us to a really profound synthesis of what we've unpacked today. If we look objectively at the data and the structural changes in the global economy, it is clear that The Intelligent Investor is a masterful historical document.
Unquestionably.
It beautifully details how a highly rational actor could navigate the tangibly driven, newly regulated American industrial economy of the 20th century. But your dossier makes a compelling case that treating it as an immutable scientific text today is fraught with peril.
I'd say it is intellectually dangerous. I mean, rigid adherence to Graham's specific dogmas misprices the entire intangible economy by failing to value R&D. It actively rewards predatory corporate behavior by incentivizing aggressive asset stripping and the weaponization of share buybacks to hit EPS targets.
Right.
And its outdated psychological allegories leave investors completely blind to the algorithmic and geopolitical risks that define modern capital flows.
Yet, at the same time, the behavioral discipline Graham championed, the insistence on demanding a discount to underlying value, whatever that value may be, and refusing to get swept up in speculative mania, that feels like the only anchor we have in a market dominated by momentum and hype.
It is a critical anchor.
The landscape has undeniably changed, and perhaps the old topographical maps of PE and PB ratios no longer describe the terrain, but the human tendency to overpay for a compelling narrative hasn't changed a bit.
The challenge is updating the mathematics of risk without losing that behavioral discipline. You know, questioning the foundational texts of any discipline isn't about disrespecting the author. It is the only way that discipline evolves.
And that is the exact analytical approach we want our listeners to cultivate. True intelligence requires actively abandoning the comfort of rigid, past dogmas to embrace the complex reality of the present. We advise you to apply this probing lens not just to finance, but to any universally accepted sacred text in your field to build your own mental immunity. Thank you for joining us on this deep investigation, and remember to subscribe to Cognitive Dose as we continue curing blind spots. We will see you next time.